Okay, it is 10 o'clock and I think we are ready to start. Hi everyone, thank you for dialing in for Bursa Malaysia and Maybank Himing's IHH Investor Day. Today we have on the line from IHH Healthcare Berhad, Dr. Kelvin Loh, Managing Director and CEO, as well as Mr. York, the Group CFO of the company. As well, we also have today Maybank's Deputy Head of Malaysia Research, Jasmine, as our moderator for the Q&A session. Before we begin, I would like to highlight a few housekeeping rules, please. Please note that all participants' microphones have been muted to prevent background noise and interference. This session will consist of a quick presentation followed by Q&A. If you would like to ask a question, you may click the raise hand button to join the queue or enter your questions into the chat box. Please state your name and company before asking a question. That is all for housekeeping. I will now pass the mic to Dr. Loh to begin the session. Thank you.
Hi, good morning, everyone, and thank you so much for joining us today. I'll do a quick presentation. I think many of you might have already heard our Q2 results, so I'll just give a quick view of our results and our strategy, and then open the floor for Q&A. So once again, through this whole COVID times, we were really focused on building trust with our patients. Firstly, taking care of both COVID and non-COVID patients, making sure they are safe. I think that has done us really well, much in line with our strategy, tested our strategy, but clearly demonstrated that very same importance. Patients found our hospitals to be safe. That has enabled us to recover well through the COVID times as both the COVID and non-COVID volumes grow. On a longer term basis, we actually continue to execute on the other strategies of building trust with our patients, including enabling greater convenience, digitizing our services, for example, launching telemedicine across our entire network, continuing to focus on our value-driven outcomes to make sure that they're transparent about the clinical outcomes and also the price at which our patients pay, and making sure that's of great value. And of course, protecting our staff and innovating as well in terms of how we test for COVID to take care of the community. So with that, we continue to execute on the rest of our other strategies in terms of synergy and growth creation. On the next slide. So during these times, we executed on that operational excellence drive, which enabled us to pull through the operating synergies across our network. That has improved our P&L quality. With that, we were able to grow as we recovered during these COVID times. And so the result of that is that we are in a strong position now at this point in our strategy, and we are well poised now to continue that next phase, which is developing that growth, that sustainable growth on our business, of course, on the bricks and mortar part of the business in the hospital assets, and also the related platforms here, which we are excited about. We have a global diagnostic business that has just accelerated during these times. We are now also expanding our care beyond the hospital walls in the digital space. And over time, we are investing deep in data analytics so that we will be able to improve our processes and also deliver care at a much more customized level. We see that as not only improving our care, but actually enable us to improve our operating efficiency beyond what we have already done. Next slide. So the result of that has been that continued improvement in our return on equity. These are the various building blocks during these times. You can see as you go further up, that's where we'll develop the sustainable growth platforms I talked about. We'll continue to fire up new revenue streams and improve our ROE. At the bottom left, the building blocks that is substantially done, much of that already coming off into Q2. Next slide. And that's you can see that in our Q2 results. Next. So that's where we have come out, precisely because of that strategy. I can see here that revenue in Q2 21 improved by 66% over Q2 20. But Ebitda and net operating income, even if you strip out exceptionals, has grown much more than that. And that attests actually to that improved P&L quality that I talked about. On the next slide, I can see our recovery here coming off that worst quarter in the COVID times in Q1 and Q2 20. Next. And on the ROE front, we had made that commitment somewhere beginning of 20 to double our ROE as one of the markers in terms of where we wanted to go. We have achieved that. You can see here in Q2 21, our headline ROE is actually at 7.2%. That has some COVID boost in Q2, admittedly. And if we strip that out, we're still probably at somewhere around the 5 to 6% level. Rest of the balance sheet indicators, of course, we very, very strong position in terms of debt over equity. We are generating a lot of cash. I think you'll see that as well in the subsequent slides. That enables us to now be poised for our next phase of our growth journey. Next slide. So here it is. We started the quarter, or we started the year actually, on 1st January with 2.3 billion ringgit of cash. You can see after substantially paying down some of our loans, we're still finishing the second half, finishing the first half at about that 2 billion ringgit level. So again, very strong cash generation, and this is still during a recovery period. Next. Okay, I think we won't talk through this one, and I'll probably stop here. And happy to answer any questions.
Right, thank you very much, Dr. Loh. We've come to the Q&A session of this presentation by IHH. And again, I'd like to remind you that if you have any questions, please raise your hands or please type the question in the chat box. So just to start off with, Dr. Loh, if I can just talk about your ROE expectations or strategies going forward. Because when you first formulated this strategy of doubling your ROEs, you were from a base of about 2% ROEs back then. And this has been achieved now that your base ROE is about 5 to 6%. You've actually achieved it in a much shorter time than anticipated. So moving forward, looking at the building blocks that you were talking about initially, if we can discuss each individual component separately. Firstly, with regards to reducing losses from entities, can I ask, apart from Gleneagles Hong Kong, which actually broke even at the Ebitda level in May this year, which are the hospitals, or how many hospitals are loss-making at this point in time, and how many do you think are optimistically expected to break even in the near term? Thanks.
Thanks so much. So let's start there with regards the reducing or working off these loss-making entities. Maybe we should talk about some of the big blocks from the past, which had caused a income drag. I think one of the key ones was the forex debt in our Turkish book of business. About 2 3 years ago, back from today, we probably had something like 600 million euros of debt. Today, that was unhedged. Today, that's completely eliminated. Almost all of it is hedged or has been paid off. So that effect is gone. That's one of the big loss removals from at the income level. Then indeed, Gleneagles Hong Kong was a startup greenfield business that has now turned Ebitda positive. We are working towards the next milestone for EBIT positive. And then, of course, our India operations, both the non-Fortis and Fortis business was actually a income drag as well. So the non-Fortis part of it, I think those who follow us will be familiar, was actually not doing well for quite a few years, running up even pre-COVID. But happy to announce that the structural improvement in our Indian operations is permanent in the sense that yes, there was some COVID boost that have given it an upside during some of the peaks of COVID in India. But now, as COVID has fallen off, the improvements we have put in place by way of driving operational excellence, removing unnecessary costs, filling up bed occupancy with non-COVID volume, that's paid off really well. Those operations are no more a drag. And likewise for Fortis, I'm very pleased that Fortis being one of our latest major acquisitions, we have been able to put through all the operating strength of the group to bring it from a place that was both penny and Ebitda negative to now very much strongly Ebitda positive and indeed penny positive with or without COVID. So I think these are a couple of things that was a drag, and we talked about that loss removals. Now there are some of these smaller things within each of our home markets, which of course we continue to work on. And as we have spoken of before, we will drive a capital efficient allocation strategy where we focus our growth we use our capital to focus our growth where it's going to be much easier to grow in clusters where we are strong, and conversely we may divest out of areas where it's not doing well, has high overheads, standalone type hospitals. So that will you find us entering some of these divestments over time.
Another one of the building blocks is actually the improvement in productivity and reduction in costs. So essentially, with regards to the original 100 million cost saving strategy per se, through your procurement synergy program, you've more or less achieved that this year already. How much more savings do you think you can drive in the coming years?
We'll continue that effort. So I think it's fair to say that over time, given that we launched it as a big major initiative in 2021, we might start to see a leveling off, right? I don't think we'd expect an acceleration upwards, but 2022, I think there's still significant headroom, and I guess that over time it start to have a more marginal effects. But I think 22 there'll still be some fair bit of room. Sorry, Desmond, I think you somehow got.
All right, sorry. Yeah, sorry, I was on mute. So the third building block is actually the new revenue streams. Perhaps you'd like to elaborate a little bit more about what those.
Yeah, there are the new revenue streams, but maybe quickly I'll talk about the middle blocks as well. Maybe if you want to flash out the slide, that might help. I think the middle block is also very important. I'll get into that new revenue streams. As we come out of COVID, we have still beds to fill, and that middle block around improving bed. So improving productivity, reducing costs, I think we talked about. By the way, the procurement is one part of it, but there are many elements in there, of course. Then improving occupancy is a very important driver of the ROE improvement, because we have a platform of very significant scale. We have 80 hospitals. As we come out of COVID, not all hospitals are yet at a very high occupancy rate. In Malaysia and Singapore, for example, the beds, there's room to fill. And beyond already built beds, there are buildings and land that we have that we can easily add on beds. And that is a very capital efficient way to grow, right? And has high ROE because it's much of it's sunk cost. So that is a first order of priority in terms of growth that will improve our ROE. Now, the new revenue streams refer to growing that business beyond just the hospital walls. We alluded to some of it earlier. We call it new only because we look at it as a distinct platform now, and that's our laboratory book of business. It's been there before. We're already the largest laboratory in Malaysia, Singapore, and in Turkey. But we're seeing us having that substantial ability to grow our laboratory business beyond just serving our hospitals. The COVID times has clearly shown that, and now as we get out of COVID, we're seeing strong growth in our what we call the outreach business beyond the hospitals. So that's one. Two, then is our digitalization journey. We see that as having a high ROE capability as well, just like the laboratory business, because it is less capital intensive. You don't have to build. You don't need huge capital in terms of land and building, but it actually extends, right, the capability of our entire bricks and mortar platform that's already in place. In fact, I go as far as to say that it's a strength that a player like us has in this going into this digital space that other players will not have, because it's easy to build an app, but then patients that require care can't actually just, for most part, be treated substantially online, right? You really need that both online and offline connection, which we can build. And therefore, this digitalization becomes for IHH a powerful lever of extending our care and expanding our care beyond hospital walls, and thereby creating that new stream. Now, beyond that, adopting more novel technologies, I think, will also give us a boost in this direction. Some of it involves using advanced data analytics. I've spoken about that earlier. The data that we have and will continue to amass, we'll feed it into AI engines. Machine learning enables us again to much more cost effectively and widen care, right? Instead of using highly specialized doctors, for example, to do a particular diagnostics or reading, it is now increasingly possible to use that data and feed it through AI engines, and therefore expand that care extensively at a very low marginal cost in future. So that's another stream in terms of the innovation space. And then there are others as well in terms of new technologies in medicine, whether it is in advanced genetic testing or in terms of novel therapies in different fields of medicine, including cancer. So I think those are the broad areas, and basically thinking about our laboratory book of business, digital, and then other innovations, which will bring online on top of our bricks and mortar hospital business, which is in the lower building blocks.
Right, thanks. In fact, I'd like to remind
that's the growth journey forward that we're talking about. And of course, and I'll just quickly finish off to mention, I think it also, I should mention that other than the organic growth on our hospital business, we will, of course, now with the operating capabilities as the know-how in all the clusters we're operating, then we will look for accretive acquisitions as well in this phase of our growth journey.
Right. Thanks, Dr. Loh. In fact, I'd like to remind participants that IHH's lab business is doing very well at this point in time. It already contributes to about 12% of revenue, and the Ebitda margins are more than 25% here. So it is growing pretty nicely, actually. Before I get to some of the questions in the chat box itself, can we just talk about the current situation per se, in that the first half was actually a very decent period for you all, and congrats on the strong results in that revenue was up 34%, your EBITDA doubled, and you actually turned in a profit versus a loss in the previous half year itself. So now looking into the third quarter and into the second half, let's take Malaysia, for instance, with the lockdown itself, how has it impacted overall revenue streams as well as the inpatient volumes in the hospitals in Malaysia?
So first off, as a broad generalization, I'd say that across all our markets, we see continued recovery of the non-COVID volume, the elective workload that had gone away during the height of COVID time. So quarter after quarter, that continues in every market. The pace of that is different in different markets. In some markets like India and Turkey, where COVID has been increasingly a non-issue or an issue that's sort of behind and moving into endemicity, then and there are no more in any form of movement control, then you find that the non-COVID volume recover fast. In the other markets such as Malaysia, that recovery continues, but maybe at a more gradual pace. I expect that as Malaysia moves out of movement control orders, as they are now doing substantially, then we'll see that start to pick up as well. Now, for Q2, even as for Q3 and Q4, even as that recovers, I think one watch out that a short-term watch out that I mentioned is that in Q2 there was a very strong COVID boost, right? Particularly in India, and then to some extent also in Turkey, Malaysia, Singapore. And I think we have to remember that, and as we get into this crossroads where we come out of COVID-19 into full recovery, but there might be a substantial fall off of COVID work as well, which has given us earnings, revenue and earnings, right? So Q3, Q4 may well be that crossroads point. So I think, as we have said before in our Q2 results announcement, I don't think we can then multiply, right, the earnings that we saw in first half simply by 2, project that in the Q3 and Q4, simply because of the crossroads in our journey. But I want to emphasize that the non-COVID board business is quite clearly coming back, and we see that recovery will continue well into next year and beyond.
So, in fact, one of the other challenges that you mentioned in the second quarter itself for the second half would be, the shortage of staff. And just wondering, to what extent can this problem be addressed at this stage?
That problem is most acute in Singapore, less so in the other markets, simply because of the borders control. Singapore is very reliant on foreign workforce, particularly, and it is true, especially in healthcare, including foreign nurses. So that has put some constraints that may cause some cost increases, because then there is a heightened competition for that workforce locally or domestically. But we'll cope. I think in the end, we have always coped. Our brand is strong. We are able to attract the staff that we need. It's just that for a short run, they might see some higher cost point in the Singapore market.
Right. Thanks, Dr. Loh. I'll start off with the questions in the chat box now. The first question is, how much of the COVID-related revenue is recurring, and what are the assumptions underlying this? Has inpatient volume been increasing?
I think we have a slide somewhere that shows the COVID revenue contribution in Q2. Maybe we can flash that. Has the inpatient volumes from COVID been increasing? If that's the question, then it just goes with the situation in different markets, right? So here's a slide that shows the COVID revenue contributions, and there are different types of COVID revenue contributions, as you can see here: lab testing, treatment of patients in the hospitals. And again, this is for Q2, and you can see different percentages in different countries. The percentages simply is a reflection of the size of the COVID spike, right, or that wave that happens in that country. You can see India, for example, was at 31% in Q2 simply because there was a huge spike of the Delta variant in Q2. But India got out of that really fast, and I dare say that for Q3 you will see a substantial fall off of COVID revenues in India. Likewise, in Singapore, I think that's likely to substantially drop as well as we go down, especially the lab testing. But Singapore, for example, has now decided to, for most part, not use PCR as a testing. So our labs may see less PCR volumes in Singapore in the second half.
Okay. The second question.
I think if you go a bit further, I think your question was also looking at forward looking. I guess if you look at the COVID revenue contribution and lab testing, then at one stage we also need to consider that some of this is likely not going to go away. Some of this is going to stay with us, and it's not going to be called COVID-19 business. It's going to be called mobility testing services or emerging disease testing. And I think our business units are starting to prepare exactly for that. Now, will that allow us to stay on the identical levels as we are today? Likely not. There is going to be a melt-off. Is the melt-off 30%? Is the melt-off 40%? I don't think we really know that. What we know is the melt-off is much slower than we had anticipated, and that's a good thing. So we see there's an ongoing demand for these services, and it carves out a completely new revenue stream for us that will stay with us, and it will allow us to pivot this laboratory and this whole new revenue stream activity. Now, don't forget, those part that is melting off, let's say it is 30%, let's say it is 40%, we are still a fraction of our medical tourism than we had been until before. So our current belief is that the melt-off is not bigger than the growth in medical tourism. Likely, the melt-off is a little bit smaller than the increase or the bounce back in medical tourism. So your net effect is either zero and we stay where we are, or we are improving compared to this. So I think we do take a moderately positive view around the business structure we have. There is a new revenue stream that will remain with us, and it is quite substantial.
Thank you very much. Yeah, that was very useful. The second question is, what has changed in the way that you've managed India, because it had been struggling for many years before this?
So I think India is both non-Fortis book of business as well as Fortis is a really great example of how one of the strategies I talked about from early 2020, where we said that we have a huge amount of operating know-how. Let's systematize that, let's codify that, but understand the local constructs and nuances, right? And bring that operating capability to bear. And that's really what we did. So in every area of operations in India, we basically found ways to make it more efficient, whether it is in terms of hospital staffing levels, whether in terms of overhead, whether it's a supply chain, IT delivery. So we did all that. We had a SWAT team that does what we call lean improvement projects as well. And so basically we drove a lot of operating efficiencies in India, and that was our main focus actually for the last 2 years. India is it's a competitive market, right? There's pricing caps, so you can't, it's difficult to differentiate ourselves simply by delivering higher and higher service offerings and then charging for that, because there's a lot of price caps. At the same time, there's a lot of competition. So therefore, the success comes from deep operating know-how, right? And that's what we have been able to do. So our Indian book of business, both the Fortis, non-Fortis one, even if we take out COVID now, I dare say that Ebitda is well into the high teens, and certainly can be positive. In terms of headcounts, for example, in the non-India operations, during this whole process of efficiency drive, we probably took out something like 300-400 headcounts, but without compromising the quality of care of patients.
Thank you, Dr. Loh. The following question is, what and how would IHH expand its digitalization strategy platform? Is it via building it yourself or through a partnership program?
The answer will be both. We are biased towards building much of the major blocks ourselves, and I'll speak to that. And then, of course, we look for partnerships as well, because we not necessarily can do everything. Now, what are the blocks? So firstly, at what we call it a digital foundation level, that means making sure that our processes, internal processes are digitized and data is captured digitally, so that then that can be used for data analytics. Then, of course, we will a lot of proprietary knowledge which we'll develop. Of course, we may use some large common software for the back-end ERP type systems, but we build that IP in the digital foundation layer aggressively. Secondly, then, as we will build that interface with our patients, right? I spoke of that offline to online seamlessness. So as we speak now, we are aggressively building out our app capabilities in all countries, which means that patients can interact with our hospitals in a much more convenient way. You can search for a doctor, book an appointment, start to do registrations, start to get your results, trend results, start to get advice online, teleconsults, etc. So that we are building much of that as our proprietary know-how. We'll continue to accelerate that. In fact, over the next 3 to 4 years, we're probably going to invest an order of magnitude about 300 million ringgit, 300 to 400 million ringgit in the digital space. And why? Because the technology is simply available for us to mount that entire care, right, on top of our hospitals. And I think pains to emphasize that that is the lighter weight part of that care delivery, right? The consults, the maybe even sending repeat medicine, lab testing, internet devices that track some of the bioparameters of our patients. We keep in touch with them, and when they have acute needs, then they actually come into the hospitals, right? And again, that app facilitates that digital connectivity facilitates that. And that frees up our hospitals to then focus on the part that they really need to focus on: patients coming in the middle of the night for their appendicitis, cancer patients with a tumor that needs to be taken out, patient with heart attack that needs an angioplasty done. All that would be done in the hospital walls. But that digital space enables us to simply extend the care seamlessly beyond. Now, then the partnership part of it will do, for example, deep know-how in AI capabilities, which simply advances our care. There may be startups, vendors who have developed specific capabilities in specific areas. Maybe AI, for example, in breast ultrasonography, for example. Maybe we do a partnership. You have noticed that we are already starting to invest into partnerships in some of these digital players. So that's how we see it. Again, not digitization for digitization's sake, but bring our entire hinterland, which then uses digital to expand it.
If you look at all the applications, patient apps, digital patient interfaces that we have rolled out in all our markets, we have far above 1 million downloads, subscriber downloads. And we are gradually, with this huge investment into a much more digital engagement focused approach, we are pivoting to say, do we need to add a subscriber-based business line to our revenue generation model? And I think this is one element of the digital transformation that we will, over the next 2-3 years, look into and develop. And say, look, there is a subscriber-based model people do want to engage with us before and after they've been to one of our facilities. And this will enhance patient experience, but it will also enhance the emotional connection to our healthcare services and bring people or keep people in our network.
And overall, therefore, everything is focused around engaging that patient, right? Putting that patient in center and empowering the patient in such a way, in a positive way, to navigate the healthcare system like never before, as York had mentioned, so that it's not only when they need to get into hospitals, but it's across the entire continuum.
Thank you. I see a raised hand from Muzaffar from Aberdeen. Muz, could you unmute yourself?
Sure. Thanks, Desmond. Hi, Dr. Loh. Thanks for spending time to talk to us today. I have 3 questions to ask. It's mostly to understand how you run the business. The first one is, maybe I'll go through one by one. How much operating autonomy do the management teams of each market have? And how much control does HQIU and your team retain on capital expenditures?
So thanks so much for that question. So broadly, of course, there is we have a strong strategic governance framework. We are very clear about how capital is allocated. We have principles for that. I've spoken several times around how we will use our capital efficiently for growth around that cluster strategy. We're going to start to develop that new streams as well. We scrutinize technology, not just for technology's sake, but make sure that it delivers the right value for patients. Then, of course, has that right business returns. So strong framework around how capital is allocated and strong guidance to the countries that requires, of course, approval at HQ level. In terms of now, but when it comes to execution and that autonomy of making sure that service is delivered best in the local markets, there is, of course, significant flexibility. We do not attempt to control the operating model in a one-size-fits-all way across different markets, simply because the dynamics are very different. The markets are completely different, price points are different, regulations are different, market dynamics are different, how you acquire patients also may be somewhat slightly different. So the local team then uses the best of the operating know-how that we have. I spoke about that earlier, but localizes that right to their setting, and that's what creates that's the power that IHH brings about. That's the parenting advantage that we bring. So we bring about more efficient ways of raising capital. We have strong guidance for how that capital is allocated, and then we have that parenting advantage that comes from a lot of the operating know-how, systems that we have, IT, digital, and so on, which of course then we enable and empower our local management to customize that to the local setting that serve locally better. Does that answer the question?
Yes. So just to make sure I understand it correctly, when it comes to, let's say, when they do planning for when they want to buy a new machine or something, that process will come to HQ. There will be a conversation with HQ.
It depends on the size. I mean, we won't micromanage. You're going to buy ECG machine and all. So
okay.
That is to do, but you're going to buy a huge linear accelerator, proton beam, then of course we look at value for patients, think about the ROI, and then for approval.
Right. And
then it's a larger strategic investment.
And what you mentioned just now on ROI, is that the single most important metric you think about when you think about allocating capital, or is it actually a bunch of KPIs?
It will be. We have to look at various things. The ROI is definitely one of the big drivers, but definitely we look at other things too, right? Firstly, is it in line with what value we want to deliver to our patients? Are there other strategic considerations? Then, yeah, ROI is a big one.
Lastly, on the personnel costs related to your, I think, 65,000 employees or something like this. A lot of people. How much is for HQ staff only?
A very small percentage. Yoga, do we have that number? And HQ is probably something like, staffing wise, out of 65,000, HQ probably has something like 200-300. It's so I can't. I have a tiny fraction.
Yeah. With 200 people in headquarters, and out of the 200, you probably have half of them who provide shared service functions to operations like IT services and others. So if you look at, if you really drill down into corporate governance costs, you have less than 100 people.
Correct. Thank you very much. Thank you for the answer.
Thank you, Moose. So moving on with the questions online. The next one is, can you please elaborate on your capacity expansion plan over the next 3 years? Where would the focus of capacity expansion be by country and by greenfield versus existing hospital expansion? Thanks.
Thanks so much for that. So the focus definitely will be firstly expanding volumes without even adding to physical capacity, right? So I alluded to that as we come out of COVID recovery, there are beds to fill. Foreign patients are not back yet. You can see occupancy. I would say that despite that, occupancy in some of our markets, Malaysia is running somewhere around 50% right now as we come off this phase of COVID recovery. Singapore is about 60+%. So there are beds to fill, and that is the first order of our continued recovery, which will help to drive up the ROE. And then, of course, we add capacity to our existing buildings and land which we already own, right? So those are a given, and there's a fair bit of room there still. And then, of course, then we go on to, okay, so let's say that around Klang Valley, around Kuala Lumpur, for example, we start to fill up the beds, and then we find a relatively underserved location by our network. Then, of course, we put a greenfield there. A greenfield in a cluster of area around Klang Valley, we're already strong, or around Singapore, or around the Delhi region, or around Istanbul, we have found that we can get to Ebitda break-even within 12 months. So that's why we prioritize greenfields in such locations. Beyond that, is it possible that we do launch greenfields elsewhere in new clusters? It's possible, especially in our home markets. But I'd say that to enter into a new market, then we'll be more reluctant to fire up isolated greenfields.
Thanks. Ebitda margins are higher than 2019 across most countries except Malaysia. Can you please share on the expected trajectory going forward, country by country, as COVID normalizes, and what are the drivers? Thanks.
Thanks for that. It varies. It's slightly different in different markets. I think if you look at the spikes of COVID, where COVID has added revenues and earnings, it's fair to say, as you had mentioned, that some of that might melt off. How much of that in the next 2-3 quarters, we don't really know. Could be 30-40%, and then our normal book of business starts to come back. That normal book of business comes with some cost, right? Because when you take care of surgical patients and so on, then it has a higher cost, or so-called not higher cost, but a normalized cost base. So some of the boost in that earnings that's coming from that might go off a little bit. I think Singapore is an example where you see earnings go up to a very high, relatively high margin level, getting into 35% Ebitda levels. That is in the last 2 quarters. That's probably a function of, for example, government grants, a lot of COVID testing services that might come off a bit. Now, but that is, I would say, a transition or crossroads, right? As we then go out the next couple of quarters, the next 1-2 years, and if you follow the strategy that I just mentioned in terms of that capital efficient model, filling up beds, then you'll find that the earnings margins will start to progressively climb up again, simply because we are more efficient, we are better asset turns, and we are sweating our assets better. Will it immediately jump way up beyond where it was 2019? May not, but that trajectory will certainly continue in a progressive way after the current sort of normalization period.
Thank you. Next question is, how much business value do you believe personalized services using data analytics would possibly add to IHH's revenue? Would you actualize income via preventive healthcare services or other means?
The answer is yes. It's a continued journey of learning in this space, very nascent area, but personalized medicine is the way to go in future. Why so? Because we have a lot of data, powerful analytics capability that then enables us to customize care to level of one. But that will be a journey, I'd say probably over the next 5 years. And then, of course, while we are largely in the acute care space, most of our revenues are currently earned, and I think will still be earned on that big treatments, right? That's what we do. But definitely, that subscriber base via extending our care beyond the hospital walls we have talked about will enable us to get into that new revenue streams as well in the preventive space.
Doubling ROE from a low base seems very well attainable. What is the upside for ROEs beyond the current target? And would measuring it by ROTE be more appropriate given the large intangible assets on the balance sheet?
Yeah, thanks for that. I'm beginning to be reluctant to put out another marker because the last time I said double the ROE, then we achieved that already. I think suffice to say that we believe there is clear upside from where we are. Short-term wise, temporal melt-up of COVID, but the trajectory is very much intact. I think we could get towards a double-digit level in the future, but progressive journey.
Right. I think we need to be realistic, right? From the 1 to 3% level where the company had been in the last couple of years, there was the need for a bounce back to a much more adequate earnings level. I think we have achieved that this year. So there was one massive step up function. What are the levers from where we are now? The levers from where we're now are substantially more complicated to press. We have to increase earnings further, of course, after such a big jump up. Look at our net income over past years and look at the income that the street is currently estimating as consensus for this year. There is a quantum leap, right? So we're basically doubled our net income or PATMI level, which is giving a major step up. Now, doubling from there is going to be unlikely.
So yeah, this is not like the Delta variant, that the doubling time remains the same no matter how long you get into the pandemic. But let's just say that I think what York is saying, the next doubling is unlikely to be 2 years, right?
Sure. Yes, I think we need to be careful on the trajectory. There is going to be improvement going forward. I think Calvin mentioned it, double digit is something we are thinking about. How could we get there? I'm not sure it's already a target. I would be a bit more cautious around that. But it's certainly something we're thinking about on how do we get to something that is in that range.
Fair enough.
We do expect, since the temporal COVID thing, we do expect progressive continued push up on our ROE.
Yep. Given that Hong Kong has achieved Ebitda break-even, should we expect Hong Kong to generate higher Ebitda in the next few quarters?
Yes, for sure.
Okay.
We've started to no longer talk about Ebitda in Hong Kong. We've started to talk about net income and PATMI break-even. going to take a while to get there. Maybe not next year, but the year after. We do believe we have a shot at being net income positive.
What is IHH's value proposition given its new strategy plan direction?
So, very deep question, but I think fundamentally that's captured in our purpose statement. It says touching lives and transforming care, and I think what we mean by that, if you take into account what I've said so far, our ability to transform care, right, to engineer care better and better, continue to improve the value we deliver to patients, that is the clinical outcomes, while creating the efficiencies around that, improving the know-how around that, improving the technology around that, and at the same time, getting that cost down simply because of that amortizing over a very large base, the development of those capabilities. That's the transforming care part, right? Stronger outcomes, improved outcomes, while in a more cost-efficient way. That means greater value in a more convenient way. And we can do that across all our constituents, enable all our constituents to do that, as we had explained earlier. That is that great value proposition that we bring about, that's transforming care part. And then, of course, with that, we'll touch many more lives in the business of healthcare. That's in the end why patients will choose us, will come to us, simply because we have that ability to make care better. Not just better, but in a way that's that when the patients come, they say, oh wow, yes, for that I paid, that was well worth it, that was great convenience, the outcomes was great. And that's why I trust this network of hospitals, this healthcare network, more than others.
Thank you. The next question, I'm not sure whether you normally provide such data, but the question is, please provide expected ROEs by country.
Yeah, look, I think that's the first question is ROE the right measurement on the country level, or should we look at return on capital employed or ROIC? Because look, the leverage position, how much debt equity you have in each country is a corporate decision based on cost of debt and currency exposure. So I think what we do is we do go in and say, do we have ROCE targets for each operations? And we are in the process of developing that and deploying that. And you have a couple of countries that have very, very high ROCE performance. If you look at Singapore, if you look at some assets that we have in Malaysia, if you look at our laboratory business is ROCE-wise the absolute shining star in our portfolio, and that is why we believe more money needs to go into growing such areas, growing the lab business to really blend the mix upwards.
Right. Thanks, York. The next question is, can you share with us what made Hong Kong Gleneagles see a faster break-even on Ebitda?
Oh, thanks for that. So did I hear the question correctly as what made Gleneagles Hong Kong have a faster break-even?
Yes, correct. Faster break-even on Ebitda.
So yeah, I think Gleneagles Hong Kong is a great example of how we actually had the ability to launch a new hospital, put a brand that is hitherto unknown in a new market. During the whole COVID time, from Q1 of 2020 all the way to now, while occupancy is actually dropped in most Hong Kong hospitals, our Gleneagles Hong Kong never saw a drop. In fact, quarter after quarter, it saw a climb in patient volumes, and that's why You see we reached Ebitda break-even in May. So really it was a function of volume growth despite COVID. And I dare say that if not for COVID, the operating capabilities that brought about into Gleneagles Hong Kong, the brand that is built, the outcomes that doctors and patients started to see, the kind of facility that we have, the service processes that we had were well recognized, and that brand was simply built fairly rapidly over that 3+ year period, and that's why we got to Ebitda break-even despite COVID times.
Thanks, Doctor. The next question is, what are the non-core assets for IHH look to divest?
Yeah, thanks for that. I think I talked about the strategy, about how we are thinking about divestments. So if they are, and really it's in spaces where, for the hospitals, it's in spaces where we don't think it's going to become a strong cluster. Might be isolated type facilities which not doing well, does not have overhead efficiency. So we consider asset recycling in those areas. If there are specific announcements, we'll certainly let you know.
Right. Thank you. There are 3 parts to the next question. I'll just ask them one by one. Given the restructuring of the lira debt and the euro contribution to Turkey's revenue, does the lira depreciation now work positively in IHH's favor?
Well, firstly, I'd say that the effect on our earnings, the big negative effect on earnings, that has been eliminated, because obviously if you borrow in forex currency like euro or US, and then you earn in lira and lira depreciates, that's a big problem. We've solved that problem. I don't think though we would say that in any business, healthcare otherwise, if you operate in a country when there's a depreciation, I don't think that's in your favor. But because it's a local business, costs are then largely local. You earn liras. In Aceh Padang, we have a very strong brand. In the case of depreciation domestically, we have the ability to then match that with inflationary price increases. So that business on an operating basis is well protected itself. Operating earnings are strong. So that's where it is.
Okay. What is the targeted percentage of euro revenue, and how much of the cost base is in euros?
So right now, as we speak, the hard currency earnings, euro and US, A, because of foreign patients coming into Turkey, which are paid largely in euros, and B, because we have established that beachhead of operations into Europe, which of course earnings are in euro or euro hedged currencies. Right now, it's probably around 40% of the entire revenues of 35 to 40%, and we expect that to continue to grow. So as to the earlier question, if lira depreciates, firstly domestically, that's already operating on operating basis hedged, but also we are growing that euro revenues. It's continuing to grow over time. We expect it to continue to grow. The brand is very strong. Foreign patients have bounced back, in fact, showing signs of growth now as we come off of COVID, starting to get above pre-COVID levels. And then the European business that we have started, again, because of the very strong capability, we have shown that we can operate well in those clusters that we started in Europe, and that's bringing euro currency earnings.
I would like us to think about this Turkish lira and euro topic in a way where it's not our business to speculate on how a currency goes up or down, and then say, oh, if the lira goes up, then it's a benefit, or it's a. We need to look at the underlying business. Liabilities need to be hedged against income streams. The way they are, we need to minimize our exposure, our liability exposure. so that we're exactly no longer talking about FX gains or FX losses that have actually nothing to do with the underlying business. And I think we've achieved this. The hedges are in place, and we'll continue to manage it this way. But look, if you look at this chart here, you see that the international business is growing. It's a very strong cash accretive business. It has good margins. But we also see that in Turkish lira, our business in Turkey is growing substantially. So overall, this is an amazing division that has its operations in order and has a good strategy. We've eliminated the FX risks through hedging, and I think our job is to look at underlying performance and not speculate on where a particular currency goes.
Right. Thank you, York. Next question is with regards to the impact on EBITDA margins. The question is, you mentioned earlier COVID effects will be coming off substantially in India in the next few quarters, but you've guided that EBITDA margins will still stay in the teens. Could you please clarify how you expect to maintain margins in spite of the expected sharp drop in revenue?
Thanks for that question. Firstly, I mentioned that we have put through a lot of operating excellence, operating efficiencies into our India business that it will structurally stay. That helps a lot. Secondly, we have built the brand, built up the trust with patients. So the non-COVID volumes are actually coming back, rebounding very strongly in all our India operations, both in Fortis as well as our other than Fortis India operations. So for these two factors, the margins will remain strong, short of guiding, but it will be pretty much in the high teens.
Thank you. What is the direction or target given by major shareholders, for example, Khazanah and Mitsui? And could you please share some of the KPIs given to management?
So our major shareholders are extremely supportive of our vision, of our direction. They believe very strongly in being focused on patients, building a sustainable business that is based on getting patients to trust us more. They believe very strongly in our ability to deliver on that parenting advantage, as I explained. They are long-term shareholders. During the COVID times, I dare say that they went as far as say for this year, the only thing you need to do is to focus on your patients, focus on your people, keep them safe. That's what we did. In the longer term, of course, they do have targets for growth that are set on management. There are financial targets. There are also non-financial targets, of course, precisely because of this belief, the deep belief in this vision and this purpose. Indicators around clinical quality, service quality, other sustainable growth elements.
Thank you. Do you foresee revenue intensity coming off as occupancies improve with more elective surgeries?
By and large, yes, on the revenue. So maybe backtrack a little bit. During COVID times, what's happened is that the smaller elective cases tends to be deferred, right? That means to say that patients who maybe have a knee pain, might have needed a knee surgery. That's why I call smaller elective. Maybe that gets deferred up for months, and that might start to come back. Pediatric cases which have some mild illness, maybe chose not to be admitted in hospital, that might start to come back. That sort of went away for a while during the COVID times. Then what's left behind during COVID times is that cases that tends to be acute, right? Heart surgery, cancer patients. So that's why you see revenue intensity spiking up in some of our markets during the COVID times. I wouldn't say that it goes down. I would say that it starts to normalize as we get out of COVID, normalize in the sense that we then have a more wider spread or the more usual spread of case mix, right? Both the very sick cases as well as the less sick or the smaller electives. So there'll be some normalization, but it won't go down beyond, it won't go down to below levels of pre-COVID, number one. Number two, always remember that case mix or revenue intensity actually tends to go up over time on a tidal basis, simply because aging population, for even the same illness, a patient at 75 years old compared to a patient at 60 years old, you need more care. And also our ability as a leading healthcare provider, we continue to advance our treatments. We treat things which are hitherto could not be treated. So that overall case mix or the revenue intensity actually goes up over time. But if you refer to that temporary situation where the normal, there's that normalization, yes, because the electives that were smaller electives that were deferred will come back as we normalize.
Right. Thank you, Dr. Loh. We've actually come to the end of the questions in the chat box itself. So if there are those of you who have one or two last questions, you can still type them in right now. Anyone with, or raise your hands actually. So any one or two last questions? Looks like that's it actually, Dr. Loh. So we'll probably bring the session to a close now. But before that, do you have any last words that you'd like to convey to the participants?
Just want to thank everybody for your time, your interest in us, for following us. We are pleased with where we are in the journey and for your support. So we look forward to continuing the conversation as we journey forward.
Yeah. And on my part, actually, I'd like to take this opportunity, Dr. Loh, to thank our frontliners for all that they've done during this difficult period as well. They are truly appreciated. So thank you. So with that, I'd like to thank the management of IHH for being here today. Thank you to the participants as well. And we will now bring the session to a close. Thank you all.
Thanks, everyone.
Thank you, and all the very best.